The S&P 500 is the most highly regarded stock market index in the United States, an indicator of the economy and how large companies are performing. When people talk about the stock market, this is generally what they're referring to. Whether you realize it or not, the S&P 500 likely has a large impact on your finances. Not knowing some basic points about it could be costing you a large amount of your retirement savings. These are some interesting points to consider about the S&P 500 that might surprise you. Taking them into consideration could greatly increase your chances of profitable investing. You'll see exactly how often a bear market occurs, why you should be prepared for one at all times, and how you can profit from these periods. Lastly, you'll be shocked to hear what one of the most successful investors of all time has to say about investing in this index. The S&P 500 is short for the Standard & Poor's 500, which are the names of the two founding financial companies. This stock index was introduced in 1957 and consists of 500 large U.S. companies and is considered to be the best indicator of how U.S. stocks are performing. Investors often use this as a guideline to see how other investments perform, such as mutual funds, real estate, bonds, and many other types of assets. It holds stocks across all 11 stock market sectors, from technology to consumer staples. Stocks aren't just randomly chosen to be included in the S&P 500, there's strict criteria for being added to this index. Companies are reviewed on a quarterly basis by the board to see if they're eligible to be added, and if the companies already included should remain. If the companies fulfill the criteria, they can be added to the index, and they also have a chance of being removed. In order to be eligible for inclusion, it must be a U.S. company, and it must be traded on a major U.S. exchange, like the NASDAQ or New York Stock Exchange. It must have a market cap of at least $14.6 billion, with at least half its shares available for public ownership. It must have reported positive earnings for the latest quarter, and a positive average over the past 4 quarters, and it must have enough shares regularly traded. These are the main criteria, but the board also tries to maintain the proper balance between sectors, so it will give an accurate snapshot of various businesses. From 1957 through 2021, the S&P 500 returned an average of 10.5% annually, not adjusted for inflation. This means if you had invested $5,000 in 1957 and didn't touch it until 2021, or a period of 64 years, your original investment would be worth a whopping $2.98 million. With sizable returns like this, the S&P 500 is an excellent option for someone who is looking for a simple, easy investment requiring little to no research. Note that 10.5% is simply the average return, meaning during many years the index returned much higher than that, and there were many other years when it had negative returns. In the late 1990s, the index returned anywhere from 19% to 34% each year, until the bubble burst in the year 2000, returning negative 10%, followed by negative 13% in 2001, and negative 23% in 2002. After this period, there were some years of varying profitability until 2008, when the market dropped 38%, followed by a recovery over the next few years. You might guess that the S&P 500 is quite diversified, holding 500 or so companies, but this is somewhat misleading. Firstly, the index only holds the largest companies in the United States, leaving many of the small, fast-growing stocks on the sidelines. You're exposed to Apple, Amazon, and Google, the well-known household names, but what about incredibly profitable small businesses that are excluded? Secondly, the index holds many technology companies with very few utilities and consumer staples, which are critical to the US economy. Technology makes up a whopping 28% of the index, with 14% healthcare and 12% consumer discretionary. Consumer staples makes up just 6%, energy 3.9%, real estate 2.7%, materials 2.6%, and utilities 2.7%. Furthermore, the top 10 holdings, which include Apple, Microsoft, Google, and Amazon, make up over 30% of the entire index. If the technology sector is underperforming, this negatively impacts the returns of the S&P 500 considerably. When you own an index that tracks the S&P 500, you're going to receive regular dividend payments that you can choose to reinvest or use for something else. What you choose to do with those dividends will make an incredible difference in your overall investment over time. The S&P 500 has an average annual return of 10.5%, but this includes dividends. Meaning this would be your average return if you automatically reinvested all dividends. If you hadn't reinvested dividends, your average return would drop to just 6.6% according to wealthycorner.com. As noted earlier, $5,000 invested over 64 years would be $2.98 million with dividends reinvested. But had you spent those dividends, your total invested would be just $298,000, a significant difference. By owning an S&P 500 fund, you are going to be receiving a dividend payment of about 1.5% per year, typically paid on a quarterly basis. This means you'll receive 1.5% of your total amount invested in the form of dividend payments. The actual yield changes slightly as the market prices vary and companies increase or decrease their dividend payments. The average yield has actually been declining over the history of the index. Between 1970 and 1990, the average yield was just over 4% or almost 3 times higher than it is now. Part of this is due to the large allocation the index has to technology companies, which pay relatively low dividends despite high growth in stock prices. In order to receive $75,000 in dividends from the S&P 500 today, you'd need $5 million invested. When yields were much higher in the 70s and 80s, you'd need less than $2 million to receive $75,000 in annual dividends. Owning the S&P 500 is as simple as it gets when it comes to investing. Funds that track the index are offered by all major investment companies like Vanguard, Fidelity, iShares, and many more. Choosing the best option comes down to which offering has the lowest expense ratio or the fee charged for owning the fund. There are many variations of the S&P 500 that you could invest in as well. For example, you could select an SP 500 growth fund which holds stocks held within the index that place more emphasis on growth with higher risk, with high allocations to Tesla, Nvidia, and others. Alternatively, there are S&P 500 dividend funds that hold companies within the index that pay high dividends, like Chevron, Iron Mountain, and ABV. There are equal weight versions that allocate the same percentage of the fund to each company. Furthermore, there are funds aimed towards more stability and lower volatility that only select the most stable companies held within the index, like Johnson & Johnson and Procter & Gamble. When you're invested in the S&P 500 or any other similar option for that matter, you should be prepared for a large decline in its price at any time. Bear markets, or when prices drop 20% or more, occur about every 3.6 years. Fortunately, these bear markets tend to be relatively short-lived, lasting an average of 289 days. This means that a large amount of the time you're invested, you should expect to be in a bear market. As silly as it seems with how frequent bear markets occur, investors often panic. They feel as though they should sell everything to limit their losses, but this practice seldom works out as planned. Instead, understand that bear markets are a normal part of investing and they can actually mean opportunity. If you're properly prepared with sufficient savings and an extended time horizon, investing more aggressively during these periods could greatly increase your long-term returns, because you're essentially buying the assets at a discounted price. Knowing how often these situations occur on average and how long they last will help you weather the storm instead of selling out of a panic. Warren Buffett, perhaps the most successful investor of all time with a net worth of over $100 billion, recommends investing in a low-cost S&P 500 fund. As he said, the best thing for most people to do is to own the S&P 500 index fund. He even instructed his estate to invest 90% of his fortune into the S&P 500 for his wife when he dies. This is an excellent piece of advice to consider when deciding what to buy for your retirement. After all, it is hard to ignore such a simple and proven investment vehicle with an average return above 10%. Investing in the S&P 500 is a great choice for the average person who wants an easy strategy that requires little research or prior knowledge. All the hard work is done for you as the index's board monitors the stocks it holds and continually tracks them. On top of that, there are many variations to suit your type of investing style, whether you're a young person seeking higher growth or a retiree looking for more income and stability. It's tempting to pick your own investments in an attempt to make huge returns, but buying a low-cost S&P 500 fund just might be the best bet.